Banking sector worries weigh on global stocks and investors avoided risky assets once again. A European sub-index of bank shares fell by 6.5% on Friday and is on track to fall for a third consecutive week. Banking shares have fluctuated dramatically this week as traders debate whether a forced tie-up between Credit Suisse and UBS was a sign of stability or a systematic stress. For now, though, it looks more like a contingent and a financial crisis in the making. Deutsche Bank stock dropped 13%. The German lender's shares slumped for the third day. That's a third day in a row and have now lost more than a fifth of their value so far this month. That drop in Deutsche's share was driven by the bank's report, which showed that insurance costs to protect investors against the risk of its default rose sharply. Deutsche Bank's credit default swaps CDS, which measures the price of insurance against the risk of failure on debt, hit a four-year high. The German lender also said that it planned to redeem $1.5 billion of less secure debt that isn't due to be repaid until 2028. Deutsche Bank's plan to access less secure capital or Tier 2 debt shows just how fragile sentiment still is. The recent banking turmoil in the U.S. and Europe has brought back memories of the 2008 global financial crisis. U.S. Treasury Secretary Janet Yellen has tried to calm investor fears about the stability of banks. She also warned about the possible effects of the economy of a lending crunch if people move their money out of smaller banks. Yellen changed her mind on Thursday, however, and promised to take more steps to protect bank deposits. Earlier, she had said that blanket insurance was unlikely. What also exasperated investors' worries about a contingent was the U.S. Federal Reserve's decision to hike rates on Wednesday. The U.S. Central Bank, though, signaled a more cautious approach going forward because of pressures in the financial system. Still, markets are betting on a U.S. recession and incoming rate cuts.
To a range of 2% to 2.25%.